going to jump right in. Synapse Financial Technologies is a banking-as-a-service company that filed for bankruptcy this year. Millions of dollars in customer assets are still frozen. It's unclear when customers will get their money back. Sheetal, you were VP of Legal and Compliance for a year at Synapse back in 2020. Can you talk a little bit about what went wrong?
Yeah, I mean, I don't know that it's necessarily isolated to one specific kind of thing, but I think it was almost like a tipping point of various factors that all just together kind of, really tipped the boat over, and it was both Synapse as well as the bank, the partner bank, I think has a lot of responsibility. But I think if I had to boil it down succinctly, it would really be about the technology as it relates to reconciliation and this lack of connectivity between the fintech partners, the tech provider being Synapse, and the bank. And I think there was just a total breakdown. Communication, the technology actually creating the visibility as it relates to the ledgering and the reconciliation. So I think that's kind of the overarching theme, but we can unpack that quite a bit.
I'm sure we could talk the whole time about that.
Yeah.
But we can move on a bit to more of the future of banking as a service. Obviously, we touched on kind of the dark side. Itai, why don't you talk about the upside and potential of it?
Yeah, so good to be here. Unit was actually born in San Francisco, so it's good to be back. I'm based in New York. When we think about the innovation in financial services in the next 10 years, I think it's going to look very different from what the previous era of fintech innovation looked like. So if you think about 2008 to 2018, a lot of companies that innovated in financial services were challenging the incumbents and trying to do something better, faster, cheaper. So that's Venmo or Lending Club or Chime, right? A lot of companies that look like that. And I think what's happening in the next 10 years is that more companies are going to be expanding from software to financial services. And we see this as a great opportunity to serve millions of businesses, individuals, and independent workers. I mean, companies here in San Francisco are doing this. You have the Gastos of the world and the Toast of the world and others expanding from just offering software to offering financial services.
Peter, do you have anything to add about the potential of banking as a service?
Look, I think there's tons of opportunity for the building of wallets and banking services in other sorts of apps. We get hung up in thinking about how do we add banking to an existing fintech that's in the market, and that's one universe, but the real big opportunity is helping folks keep their money closer to where they're operating. So if you think about a dentist has maybe integrated with Stripe to do payments for their customers. Then the money gets sent away, they've got a checking account over at Chase somewhere like that. And everything adds time, so it takes a day or two to settle, the money's slow, and it's really, really hard to keep track of everything. Imagine if your dental practice management system included just banking and operations and do your payments and do your bill pay and keep track of payroll, all integrated in one place. That's where things are evolving. We're moving away from bespoke pools of money that are related to just where you live and bank, to money tied closer to the operations of your business.
Yeah. I think the biggest obstacle to that dream world today is probably the regulatory uncertainty. Sheetal, you come from the legal world. What's the biggest misconception regulators have about banking as a service right now?
Yeah, I mean, I think today, especially in light of the Synapse, dispute, what we're seeing is we're kind of judging the entire space by perhaps the anomaly instead of the other way around. And I think if you look at embedded finance, what Peter was just talking about, it's really an opportunity. There's so much synergy with these community banks and these tech companies to partner. And if they don't have that partnership, a lot of these community banks actually won't continue to exist because they need alternate channels to grow deposits and really to have means to kind of innovate their traditional suite of products and services. So I think the misconception is that the technology itself has no controls and that there's this idea that end user funds are not safe. And I think that's entirely false. I think the technology, there's a way to build controls to innovate responsibly and in adherence to regulations. And that's what we're seeing. We work with over a dozen bank partners that have gone through regulatory exams that are proactively engaging with regulators and kind of doing this the right way. So that's how I would characterize the biggest misconception.
What sort of features have you guys added kind of explicitly to gain trust from banks? Anyone?
So
yeah, Itai.
we have a full team dedicated to bank oversight. So I think that the easy problem that companies like us solved between 2019 to 2022, 2023, was how do you help people open bank accounts or issue cards or move money via API? This is probably 50, 60 API endpoints, and it's done.
Yeah.
Now I think the focus is shifting to what's below the water in this iceberg, and that's really how do those bank partners who are manufacturing deposit accounts, cards, and loan products, how are they getting oversight onto what those tech companies, the tech company that serves dentists, how do they operate, how do they market, what fees are they charging, who are they serving, who got disqualified, how much fraud might exist on the platform. So I think a lot of the oversight is really the future of the industry, and there is so much to be built there that nobody's talking about.
Yeah, I'd agree. I think the key is to see if there's a single source of truth for everything. And what's really interesting about the space and why regulators, or where regulators can help, is if they treat fintech just the same as they treat regular banking.
Yeah.
The challenge has been, there's sort of been this, hey, it's over here, it's different. And the bankers treat it differently. And you've just got to talk to the bank and say, look, these are your customers. Treat them just like you would any other customer. And make sure you have all the same checks and balances. And the start of the flow is KYC and identity verification. But end of day, making sure that the balance is there and make sure you understand every transaction that's posted. They do this every day with Fiserv and FIS. We're the same. And trying to put a line between what we do and something else is artificial.
Yeah, and on the topic of like a product suite, is exactly what Peter was just saying. I think if you look at the breakdown with Synapse, it was really an issue of data and the bank losing access to kind of the data that really related to the third-party ledger. And it's almost weaponized the use of a third-party ledger. But to Peter's point, I think all of us are building products that give the bank direct visibility and connectivity into what's happening on a transactional level, just as they would in their own core bank accounts. And so I think from a product perspective, that's really going to be key for regulators.
I'm somewhat old school. I remember when we launched internet banking in 1995 with my first startup. And when we did that, no one knew how to do the accounting. So every fintech platform created branch 0, which was the internet branch. And everyone was trying to say, well, is it any different? And the answer was no, it's just the same process in the same channel, but you have to treat the customer the same. And once we got that figured out, everything was the same. In fintech, it's literally the same. And if we can make it simple for the bankers to see where is everything at all times, then we're great. What's really important, though, is to make sure in the event that something goes wrong, that there's backups of information and there's an agreed upon way of pulling that data into some other system that everyone agrees and makes safe and easy.
Yeah. I want to take the other side of this conversation. So yes, I agree that what we're building is a core system to a large extent, and if that dentist could walk into a bank branch and get a bank account, they get the similar set of services from the tech solution that they're using. So 20% of what we're doing is just trying to replicate core capabilities that existed in the past. I do think that from a regulatory standpoint, there is a lot of fear about the surface areas that open up when you dramatically dial up the scale. So the sleepy bank in a place like Nebraska or Iowa, when they open up their branches to dentists walking in, they get 45 walk-ins per year from dentists that operate locally. But if they open up their gates to dentists that use tech products, they can get 5 or 10,000 signups in the course of 1 year. And for them to be able to process all the volume, the potential fraud, AML, and consumer deception that might come with these products does open up surface areas. So I think it's a combination of treating ourselves as companies that replicate old school banking systems, but also recognizing that the scale is a whole new ballgame for the regulators.
What has changed in what banks want to be able to see and like the amount of visibility they want into your product, into the end users, say maybe 5 years ago?
I would say that the big thing is that the banks no longer are in the opinion of just trust a platform like us, and which is great. They shouldn't. They should make sure that they have looked into the math and make sure that they understand how it works. So what's changed is we've been much more transparent and much more real-time updates of where is everything. Yeah. And I agree with Itai, like, while the banking is the same, it's the access and the use cases and the different ways the money's moving that create the interesting use cases and the challenges on the compliance side. And it ultimately comes back to scalability. You're right, we have numbers of banks that onboard 100 business customers a week. at the bank, and they get 10,000 customers a week through digital. And any of the processes that they had, which would be in, meeting the banked customer in a branch, none of that scales. So technology really has to jump in and help create automation around those processes to make them more effective.
Yeah, and what we're hearing from bank partners, to the point of both Peter and Itai, it's presenting a new set of fraud vectors, and so what's changing is how end customers are consuming these traditional banking products and services, which is giving rise to entirely new patterns of fraud and money laundering, financial crime. And so I think what we're seeing is our bank partners that are going through regulatory exams, regulators are very honed in from not just like the tactical regulatory pieces, but very operational pieces. How, or have you been deliberate in entering this space? How do you plan to make money? What do your contracts look like? So what we're seeing is regulators really want to see banks being entirely deliberate, getting buy-in from the highest levels, including the board the board of directors, senior executives. And so I think it's because how we've consumed these banking products is changing so drastically. Regulators are honed in from operations as well as kind of the compliance pieces.
Something that sticks out to me when I was reading about Synapse and reading about users that, were kind of can't get their money anymore was that they didn't even know what bank their money was being held in. When you're talking to banks, are you advertising the fact that they're going to get more customers even though those end users don't necessarily have loyalty to that bank, right? They see the app that they're using, they don't see where their money is necessarily being stored. Do you communicate that as customers for the bank, or how do you sort of communicate that?
So I would say there are two types of structures in this industry. Synapse was using a very specific structure that made use of broker-dealer licenses to effectively stand between the bank customers and those end users.
Yeah.
So when an end user signs up for the product, they might see the name of a bank somewhere, but it's not clear enough to them that the money is being stored on their name on a specific bank. There's a second type of structure that I think all of us are practicing, which basically makes those banks the creators of deposit accounts. Okay. And when the end user is opening the deposit account, they are accepting the terms and conditions and the deposit agreement that is made by the bank customer. So the name of the bank has to be there in very, very clear letters and language. Yeah. Now, we can't pretend that if somebody is using a bank account through Wix or Honeybook or Shopify, they necessarily know who is the underlying bank, even if it's clearly written. So I think we should all make sure that those end users understand where their money is being parked and under what circumstances it might be at risk.
Yeah.
Yeah, look, there's a number of places in the apps that they'll know which bank they're banking with. The easy stuff is in the online sign-up process, the KYC, hey, you're opening a bank account at Bank X. Then there's the monthly or weekly statements that come, and it'll be in the footer of every statement. Many of the banks require every alert and notification to include a footer that says you're being banked by Bank X. It's all progressively on the websites of the clients. And maybe the trick for the consumer is don't bank with someone that you can't actually tell who the bank is. Because if under the covers it says banking services provided by banks, but we're not going to tell you who they are, that's generally a sign of something weird going on, and it just isn't what you want.
Yeah.
And I think if you look at the consent orders of the banks that have kind of gotten in trouble for this, you've heard Mike Sue from the OCC, he calls it a supply chain, and he says the problem is you don't see where the bank begins and the tech firm ends, or where the tech firm begins and the bank ends. So regulators are very honed in. So it's almost like if you are a bank partnering with a tech company or a fintech, you have to actually disclose and you have to have a deposit agreement. So I think that, especially in this environment, it's not optional anymore.
Yeah. Well, that brings me to something else I wanted to ask about, which is how do you select a banking partner? How do you go through that vetting process? What are you looking for? Itai, if you want to start.
There are a couple of, I guess, more boring factors like financial standing and quality of leadership and the mode of technical integration with the bank. This is something that we've practiced for years. I think what became clear in the last year is that it's very, very important to choose banks that are in it for the long haul and are ready to make the right kind of investment. I think we've seen a lot of bank customers stepping into the field, trying to make a quick buck, maybe ramp up deposits quickly. And I think it's becoming very important that whoever we work with collectively, I can speak for Unit, is really dedicated to the space. And just like every investment, the banks are going to encourage J-curve, right? They're going to invest and lose some money for some time because they spend money on software, on partners, and on headcount and processes. But over time, when those activities ramp up, because those channels are going to yield a lot of activity, they can make the investment back and basically become profitable. It takes years to be profitable, and we at this point do not want to work with banks that don't recognize that shape of investment.
Yeah, I would say Treasury Prime, we work with over a dozen bank partners, and I think they really range in characteristics and really just the quality of the bank. But the theme that we see that is common in all of our bank partners who've been successful is that there's investment at every level, buy-in from the innovation team to the compliance team. And I think often what you see is the folks driving innovation and driving kind of on the business side are very full steam ahead, wanting to innovate, wanting to kind of really diversify channels. But oftentimes they don't have buy-in from compliance folks or their BSA officer. I think the banks that do it well are really aligned kind of foundationally on what they want to achieve from these partnerships.
I think for me, starting in COVID, we all did this digitally, and we met on Zoom. But in reality, this is a long-term relationship and a partnership, and so we force the human interaction. So we won't start a partnership with a new bank if we haven't met and actually sat down together and talked about the business, the opportunity, and really saw, into the intentions of where the bank wants to go. I think there were a number of folks that were seduced, as Itai would say, by it's an easy way to garner deposits that we can turn around and lend on when interest rates were in not a great spot. And now what's happening is there's much more conservatism around how those accounts should be structured and the relationships between them and their consumers. But when it all gets down to business, knowing who your partner is actually the fundamental core. And we do that both at our level as a company, but also with every one of our fintech partners. And it's real traditional. People get on a plane to Effingham, Illinois. And yes, it's called Effingham.
Can you talk me through, you obviously don't have to name names, but a time that you decided not to go with a banking partner and what the red flags were?
Yeah, I can go.
Yeah,
there.
start.
So we probably said no to a bunch of banks that were under like 500 million in assets. So they were just too small, and they didn't really understand how they would get there. The other thing that we did, which was a control that we chose to impose, which was if the bank was working with another of our cohort, my colleagues here, we generally would say no. And the logic for that is we can control what we are responsible for. We can't control what other programs are doing. And so what we're trying to manage for is contagion risk. And when we do all of these programs, everybody's worried about one program being bad, spoiling the relationship with that bank, and that bank then having consent orders that apply to every other program that's on it. And so we've been quite deliberate about making sure that we keep things clean and focused. And we're not imposing exclusivity, but we think it's much, much easier to control and manage.
Do you guys agree with that? Do you guys have similar rules when you are vetting banks?
I would say that what we do is often try to speak to the board of the bank. Boards at community banks are jokingly known as male, pale, and stale. There is a lot of old-fashioned thinking in the space. And of course, we meet many great boards, and we're seeing the product and the future resonates with many of them. But we want to make sure that people at the board level ask intelligent questions and can really kind of play back how we see the future, so that we know that we can build a great partnership. Another easy way to disqualify a bank is if we meet a compliance officer who doesn't grill us on what controls and other types of reports that they have. We know that the bank might not be sophisticated enough to stand a regulatory exam and really operate at scale in the space.
Yeah, I mean, I think for us, the way we gauge the level of investment on the part of the bank, and in our structure, everyone has contracts with each other. So the banks have contracts with the fintechs, we have contracts with the banks, so everybody is kind of connected. And by investment, it's not just dollars and marketing dollars, it's number of people, head count. How are they planning to operationalize this? And I think there are a lot of banks that are drawn to the idea of having an acquisition channel, getting the deposits, but not necessarily doing anything beyond that as it relates to oftentimes their teams are already overburdened. And so the banks that are not willing to really invest from a people standpoint, I think those are the red flags for us.
Yeah, and as much as you have to earn the trust from banks, you obviously also have to earn the trust of consumers. What is one lesson you've learned in convincing people to trust banking as a service and trust you with their money?
I would say scale makes a difference. We help serve over 1.6 million end users, hundreds of thousands of businesses, hundreds of thousands of sole props, and over 1 million consumers. So with scale, I think you get that level of confidence. We've completed an audit with a top 4 firm, and we have certifications that we can point to. I think outside certifications, in the absence of stable brands in the space, I think help create some of the initial trust. But it's a nascent industry, and there's a lot more to prove. And I think 5 or 10 years in business for all of us from now are going to really make those brands last.
Yeah.
I would say, having run a couple of consumer programs, both at Uber and Google, the key element of trust building is, do you stand by what you say? And will you answer the phone if something goes wrong? And will you actually say, yeah, we made a mistake, we'll fix it? A lot of times what happens in these spaces is you sort of try to hide things that didn't go quite right and hope no one notices. The problem is, it's real humans' money. And we all have to have empathy for the fact that if they can't access their money and go to the ATM, their lives are impacted. And it's imperative on companies like us to ensure that the fintechs and the brands that we work with have that same cultural expectation. And I think the worst thing that's happened out of Synapse is real people have been damaged. And we sort of blasé think about it as, well, it's just Synapse or it's just Evolve. But you're forgetting the actual fundamental human on the other side of this that can't pay their bills. And if you can't get that right, everything else fails.
I would say if you want to know how honest companies are, go to their status page and see what they publish on their status page. If it looks 100%, you should probably suspect that they're not reporting every incident. And if you can fish for some incidents and see that they're taking them seriously, it's probably a good enough start. So at least from a technical standpoint, this is one kind of quick indication.
Yeah, in our view, what's critically important to establish trust is transparency and understanding what roles and responsibility every player in the ecosystem is playing. And so in our view, Treasury Prime is the technology partner. Our banks are the bank partners, and the fintechs oftentimes are really kind of the touch point between the end customers and the other players. And so I think if we could establish upfront who's doing what, who's responsible for what, it really does ease kind of the tension and establishing trust. The other thing, what we're seeing too is like our CEO, Christine, would call this a bank operating system. So he would say it's so much more than just bank fintech partnerships. We see a lot of our bank partners embedding our tools for their own programs and for their own deposits. And so, on the question of why would anybody want to invest in this, we don't see why anybody would not invest in this if they want to stay relevant. And so it's beyond just banking as a service in our view.
In the very, very early days, how do you convince any bank to partner with you when you obviously don't have a track record yet?
Super hard. So when we were starting Synctera, we took a relatively unique approach of 50-50 rev sharing the total program proceeds. So we knew there weren't enough, fundamentally there aren't enough banks with supply to deal with all of the demand. We get fintechs every week coming in saying, let's go. And our banks are busy and occupied. And so we needed to build market supply. And the way to do that was to be transparent and sharing in the success. The trick was also then making sure they would share in the not success. So it's quite easy to pay someone, but then when you ask for money to be paid back, they're like, hey, no, I thought I was just getting the credits. But it's economic alignment with the bank is really pretty much the core thing. And then it's coming with a pedigree and a trust and having, this marketplace is a game where people want to work with people that have done it before. And so that helps. And it makes a big difference having really great people in compliance, great people in operations, great engineers and so forth that have been in the space before. I think a lot of the challenges and a lot of the failures that have happened are by people that weren't in the space, that saw a spec and said, I can code to that spec, and didn't realize the spec was just the tip of the iceberg of all the things that you actually needed to know.
Itai, do you have anything to add?
It wasn't easy in the beginning, and I imagine if somebody's trying to do this in 2024, it's going to be near impossible to escape the chicken and egg of building banking infrastructure. Today, we move over 40 billion annually. At the beginning, of course, we were just 2 people with 3.6 million in the bank, and we walked around banks at the time that COVID was just starting, and really trying to convince them to do something that has only failed previously, which is to build an operating system that helps them partner with tech companies. Many of them were skeptical because of the early mentions of Synapse in this ecosystem. I mean, I can't say many things beyond, be reliable. prove some track record and try to have credible investors that you can point to, bring demand and share economics, as Peter was saying. And one more thing we did, which I'm not sure really helped, was we offered equity to the first banks that partnered with us, and I think it helped kickstart those first relationships.
Yeah.
But again, I'm not sure in today's regulatory calculus if banks even care about getting an upside in a tech company if the risk that they see in this ecosystem is not something that they have an appetite for.
I mean, do you have any advice for, banking as a service startups that are starting right now?
I would say, it's in our collective interest to discourage people from building companies in this category. But I would say it's good enough that companies like Unit, Synctera, and Treasury Prime exist in today's ecosystem that you don't have to reinvent the wheel. Some companies depend on custom implementations and would have to find bank sponsors and build against a custom set of technology solutions. But today's the solutions mostly exist, and I would say that I encourage people to explore if one of us can solve their problems.
Yeah, I would say one of the things to be really aligned on is how much it's going to cost. It's basically a $100 million problem to get to reasonable scale. And a lot of problems occur with investors that come in and say, I'll underwrite your Series A or B for 10 million. And then you come back and say, well, I need another 30 or I need another 20. And the investor's like, but you said you were going to build it for 10. And so making sure you have investors with the ability and the wherewithal to continue to be with you on that journey. It's been 4 years of fundraising for us, and last year's been pretty crappy, but we've made it through. And if you think you can do it on the cheap, you can't.
Yeah, and one of the challenges that I see for fintechs that are not necessarily as successful in this space is oftentimes these are very talented, very tech-centric companies, a lot of engineers, really most of the investment is on the tech side. I think to the points we were making earlier, there's something so, there's a responsibility when you're dealing with people's money and people's data. And so if you're a fintech that thinks you don't have to at least invest in understanding the regulatory landscape, understanding kind of the universe of laws that apply. Those are the fintechs that struggle, I think, because that's what the banks are going to expect, is that you have at least a foundational understanding of how this works. And the other challenge, to your point about the banks in this environment, I think we see banks being very picky with who they want to partner with. So they want to partner with fintechs that have a track record, maybe a bit more established, have mission-based values that have a fit with the bank's culture. And so I think that if you want to be in this space, you really have to have some of that ironed out in order to have a successful bank partner.
I have a tip for infrastructure builders more broadly, which is it takes 10 to 20 years to build a successful and outstanding infrastructure business. And much of the common wisdom we have in Silicon Valley is, companies can grow to be VC scale in 3, 4, 5 years. Some companies make it, but companies that build infrastructure of that nature, that have so much to prove when it comes to operating at scale, building a brand, gaining trust, gaining certifications, gaining large customers and revenues, I think there's no going around being ready to operate for 10 to 20 years. It's applicable to people who build payroll infrastructure or accounting infrastructure or insurance infrastructure. Every kind of infrastructure takes over a decade to build. And unless you have that stamina and you're really in love with boring problems that come with building infrastructure, it's very, very hard to make it financially. I think the financial profile of our kind of businesses is one that compounds over 10 to 20 years rather than built in overnight.
Okay, so you have to play the long game.
Have to.
Amazing. That is all we have time for. Thank you for your time. Thank you for coming. Yeah.
Awesome.
Thank you.
My pleasure. Thank you.